Live from Singapore, this is Insight with me, Haslinda Amin, a show that dives deeper into the stories that matter with crucial context and sharp analysis. Asian equities follow Wall Street higher after easing U.S. inflation resurrects prospects for Fed rate cuts this year. But the appetite for risk itself could be at risk with Trump's return to office next week. And with that in mind, we speak this hour with widely followed tech investor Dan Niles, who thinks sitting on cash could be a good investment in 2025. Also ahead, Israel and Hamas finally reach a ceasefire agreement. Both Trump and Biden are taking credit. We'll discuss whether the deal can hold long enough to even consider what's next. And President Biden calls for tighter security, cybersecurity for federal agencies fearing Chinese attacks. Microsoft's corporate vice president for security joins us exclusively to discuss working with governments to protect systems. Well, it is risk on. Asia trading higher, tracking those gains on Wall Street. S&P, by the way, added 2%, the biggest gain we've seen in a day since, in a very long time. Take a look where we are in terms of benchmarks here in Asia. The Hang Seng up 0.8%, the Nikkei, SET, as you can see, CSI 300 also in positive territory. Of course, this is on the back of that easing CPI. Traders keeping that dream alive that the Fed will cut rates this year. What's changed? Well, going into that CPI print, we talked about one possibly rate cut. Now swaps traders pricing in that cut coming as soon as July. Well, we'll be talking about inflation and how the Trump administration policies will impact it a great deal in the coming weeks and months. So it's a great time to get the thoughts of our next guest. Daniel Niles is a legendary investor with a track record of making some very big market predictions and getting them right. What does he think 2025 holds in store? Well, Daniel joins us from Florida. Also with us is Bloomberg Live strategist Mark Cranfield. Dan, let's start with you. What are you making of this rally? Is it overdone? I mean, you know what? One print doesn't make a trend.
Well, you've had reactions, obviously, in both directions to start the year. You had some really hot economic prints to begin of the year. Stocks obviously went down. You had one that make people feel better, obviously, and then they went up. I think this year is going to be a lot like that, but I think on the whole, you're about 50% odds that you get no Fed cut this year and potentially hikes. So that's why one of my top picks coming into this year is cash, which yields over 4% sitting in a money market fund. And I think it's going to be a lot tougher year than last year, where we predicted the market would be up 20% on a soft landing scenario. It finished the year up 23%, the S&P 500. This year, obviously, we feel a lot more negative going into it.
But when you take a look at how markets are reacting right now, Mark, it does seem like people think the Goldilocks scenario is still intact.
You're probably an overreaction to the data yesterday based on positioning. I think particularly in the bond market, a lot of people went into those numbers short of bonds anyway. So it was a relief in the sense that the numbers come in softer than expected. So you get a lot of positioning changes based on that. Also, as I was just saying there, that some people even thought the Fed may hike this year. This CPI number on itself suggests that a hike is not going to be an easy case, but we haven't heard from Donald Trump yet. Everything could change next week once we start to see the real policies coming out of the White House.
So, Dan, what do you see the Fed doing? I mean, everything right now could be inflationary. His trade policies could be inflationary. We have oil at the highest level in 5 months. That's inflationary. And market's not quite pricing in yet at this point that could be a rate hike.
Yeah, and that's my point, is that you have to remember we went through 100 basis points of cuts by the Fed last year starting in September. That impact isn't instantaneous. It takes a while for that to feed through to the economy with a year lag or so. In addition to that, you put the incoming administration policies, which are great for growth. But don't forget, U.S. GDP is already growing at 3%. Unemployment's already down at 4%. So the economy is already very strong. You throw on top of that things like tariffs, deregulation, tax cuts, which are all good for growth, but they're also inflationary. And that's why I said earlier that I think there's a good 50% chance that the Fed doesn't cut at all or ends up raising. And if you look at it historically, when CPI has ended a year between 2.5% to 3%, the 10-year Treasury yield is up at 5.8. That's over 100 basis points higher than where it is today. And typically market multiples on a trailing basis are about 19 times trailing on the S&P 500. They're at 25 times today. And so that's why coming into this year, we've written about the fact that, it's the widest range of outcomes I can remember, and that you could see the S&P up 10% this year if inflation doesn't in fact come roaring back, and some of the things that they're trying to do in terms of the Department of Efficiency, cutting, government spending, things like that. If that works, then you can keep inflation under control, in which case the S&P should be able to go up 10% and the multiple holds. But if you do end up with inflation continuing to pick up, because don't forget, inflation's been going up since June. PCE headline bottomed in June. All the other inflation metrics, PCI core, CPI headline, CPI core, they all bottomed in the September quarter and have been going up. But the market, much like in 2021, when the stock market ignored inflation going from 1.4% to begin the year, ending the year at 7%, it sort of was trying to ignore all the increases in the inflation metrics since the middle of the year, right up until the Fed said on December 18th, our inflation forecasts had, quote, kind of fallen apart. And as soon as Jerome Powell said that at his press conference, that's when the S&P 500 went down 3% that day. And so I think that's what you need to keep in mind, is that the market kind of doesn't care until it does. And that press conference on December of 18th might have finally told you that the market's now waking up to the fact that inflation has been rising for 6 months, arguably, and it's just sort of ignored it, just like it did in 2021.
Hi, Dan. This is Mark. So you're going to be sitting on quite a bit of cash in a very strong US dollar environment. So you've got a great currency behind you. You've got some money to deploy. Are you tempted by some of the other sectors around the world? Does Asia look cheap to you, or some parts of Europe? Is there anywhere you're thinking of deploying your cash outside the United States?
Yeah, I mean, we actually took some positions in emerging markets because we think all the rhetoric and all the fear around Donald Trump and tariffs, it's funny when you hear people just sort of take him at his word at, oh my God, he's going to put 60% tariffs on China or whatever. And then they panic. And then you figure out, well, he's a businessman. And you've already had 4 years of this, where that's a starting point in negotiation, and where you ultimately end up is typically a lot better than that. So to your point, Mark, if you look at the relative valuations around the globe, yes, on a going forward basis for 12 months, the S&P is sitting at about 22 times or so. But if you look at some of these other markets, you've got the Nikkei sitting at about 19 times. You've got the Indian stock market sitting about 20 times, but the China stock market is sitting about 13 times. So a lot of these other markets have underperformed for the last 2-3 years. They're very cheap for obvious reasons. People are afraid of tariffs coming out of President Trump. But I think to some degree, and you saw that with some of the moves since the beginning of the year, is maybe they're a little bit overdone. And so that's where I'm looking, because the valuations, to your point, as you brought up, are a lot more compelling there. And then also in the US, the markets have really been driven by 7 stocks, the Magnificent Seven. And I think there's going to be an AI digestion phase. And we've been writing about this now for several months. And you're seeing signs of it from some of what Microsoft has said over the past month, which we can get into. But if that trade starts to fall apart, and given you've got 7 stocks that are somewhat tied to the AI trade that are driving the US market, that are 35%, let's say, of the S&P 500, and are trading at valuations in the low 30 times range, then you've got a huge problem potentially. And that money could also flow into these foreign markets that are a lot more hated, where the valuations are cheaper.
Dan, we'll pick up on AI and chips slightly later. Just to pick up on what you talked about, deploying your assets in markets, in Asia, emerging markets included. You talked about that low valuation in China. And as you said, it's low for a reason. Is it compelling enough for you right now to be pumping money into that market?
Yeah, I mean, we own some stocks in there, but the thing with China, which makes it difficult, is two things. They've talked about in the past where handing out checks directly to consumers, they view it as a form of welfarism, rightly or wrongly. And they don't want people to get addicted to that. So you don't get this overstimulation that you've seen in markets like the US in particular, where they were handing out checks for people unemployed, or in Europe. And so you don't have that big bazooka effect, for lack of a better term, that will drive valuations and markets up on euphoria. And so any kind of recovery is likely to be a lot more measured. The second big problem, quite honestly, is the same one Japan suffered through for decades, which is there's only two real ways to grow the real economy, right? There's population growth, and then the productivity increases on that population growth. Well, in China, for the first time in 60 years, the population went down, and based on the demographic trends, they're probably going to go down for the next decade at least. And so much like Japan had to suffer through that, unless you get a massive increase in productivity, which, given some of the restrictions on technology coming out of the US, it's hard to believe. Those are some of the things you're going to have to struggle with. So for us, we picked cash as our top pick, but we have four other names. Two of them, Cisco and Adtran, are sitting in the telecom services space. We like the mid-cap stocks today. One of our other top picks, which is KBWB, which is the bank ETF in the US, that benefits from deregulation and tax cuts. So there are other names that we like in the US. We're just saying that it could be a very volatile year, and don't be surprised. And that's why we don't have a Magnificent Seven in that group of five, which we've always had one or two stocks in there. Last year, for example, we had both Meta and Amazon in our top five picks. We don't have one of those names in there this year because we do think there's some real AI digestion risk, and there's better places to deploy. And all of those names I mentioned, mid-cap value, the bank ETF, Adtran, Cisco, those other four names, they all have very compelling valuations relative to their peers or the market.
You like mid-caps. Why not small caps? They also have compelling valuations.
Well, it's a great question, Haslinda. The big reason's the following. If you think about what I'm worried about, which is the Fed having to raise rates potentially as you get towards the end of this year, small caps struggle in that environment because they just happen to be smaller. And so a rate environment that's more beneficial to them really helps them out a lot more. And also, if the economy is slowing down, they don't have as much revenues to cover the fixed costs. If you look at the mid-cap space, by definition, they're mid-cap, right? So they're a little bit bigger. They can handle a tougher operating environment. But that's also why we say it's mid-cap value, not mid-cap, because mid-cap growth has also benefited from the same trends that have driven the overall market. And that's why we're saying mid-cap value is more interesting, because the S&P 500 over the last 5 years, if you think about it, first, it was a couple of years of investment during COVID because everybody's going online. So you have all this internet infrastructure spending happening. Then for the last 2 years, it's all been about AI. And so the S&P 500 over the last 5 years is up 82%. The mid-cap value space has underperformed that by 35% over that period of time and trades at a 17 multiple, not the 25 times trailing multiple that the S&P 500 is trading at. So, and you've seen this during 2022 when the Fed was hiking really fast. And quite honestly, during 01-02, when you had the tech bubble break, which if it gets really bad in AI, I don't think it'll be that bad, but it could happen. That also held up very, very well. And so in a tougher environment, they also hold up nicely. And things like tax cuts and deregulation help the mid-cap names more than they're going to help the S&P 500 names, where they've already got low borrowing costs. They're huge. They don't care as much about that.
Hi, Dan. It's Mark again. You're talking about the potential risk of an interest rate hike in the States. Well, we've got one very much on the radar here in Asia. There's a lot of talk that the Bank of Japan could be raising interest rates next week, of course, from very, very low levels. Now, that may well give some support to the Japanese yen. Do you think that will work out in some way as a positive? People will be more attracted to Japanese markets because of a stronger currency, or is that going to be something which breaks the sentiment? There's been a lot of money rushing into Japan over the past couple of years. Is it good or bad if they have an interest rate hike next week?
Mark, you framed that beautifully. I mean, I always say it's never the data, it's the market's reaction to the data, right? Because if I tell you, hey, inflation's going to go up 6% over a year, you may go, oh my God, that's terrible for markets. Except if it's 2021, in which case the S&P went up 27%, right? So I think it'll actually be good for Japan because the reason they're having to raise rates is maybe faster growth, some inflation. People really hate deflation, and Japan's been struggling with that for decades. And so I think in Japan's case, with the support, as you rightly pointed out, for the currency, if I were to bet, I think it's going to be more supportive for their economy versus negative. And so that's kind of how I would think about it as it relates to Japan specifically. The valuations, because the market has rallied so much from the lows, it's not hugely compelling at 19 times versus, the China market sitting closer to 13 times, but it is lower than the S&P at 22. And obviously a lot, the AI companies for the most part are all sitting in the US. And so foreign markets by definition have struggled because of that. And the dollar, as you pointed out, relative to the yen, the dollar by itself has gone up from 101 at the end of Q3 to about 109 at the end of Q4. And so that's put tremendous pressure on anything that isn't US based, right, for that reason. And so we'll see what happens going forward. But I think the way you framed it was perfect.
Right.
And I tend to be more on the bullish side on it.
Great insights, Dan. Hang tight. When we come back, we have more from Niles, founder and portfolio manager at Niles Investment Management. We'll talk AI and chips. And thank you to our very own Mark Cranfield. Still to come, we discuss the timing of the Israel-Hamas ceasefire deal with political analyst Julia Roknifard, and Microsoft's corporate vice president will be joining us for an Welcome back. We're keeping an eye on TSMC ahead of the release of its earnings later Thursday. The price gap between the company's shares in Taipei and New York has widened to 25%, making it a potential arbitrage trade. Its popularity among U.S. investors, particularly in the AI space, has contributed to this widening price gap. But some hedge funds fear that investors will keep bidding up the U.S. shares even as their premium swells to eye-watering levels. Niles, founder of Niles Investment Management, is still with us live from Fort Lauderdale in Florida. Dan, this is a theme in the tech space, isn't it? I mean, that's what we're seeing with the Max 7 as well. They just keep bidding up the valuations.
Yeah, absolutely. And quite honestly, for the last couple of years, that's been the right thing to do because the AI trend has been so strong. But I think what investors should be concerned about is if you look at the biggest spender by far on AI CapEx, it's Microsoft. And part of that is obviously Microsoft has a 49% economic interest in OpenAI, which started this whole AI theme, with their introduction of ChatGPT at the end of 2022. And Microsoft's CapEx has been growing at 70 to 80% year over year for the last 6 quarters, if you include December. But on January 3rd, they came out in a blog post and said, we're going to spend $80 billion on CapEx in their next fiscal year, which ends in June. But if you go and do the math, they already spent $20 billion in September quarter. They guided that up for the December quarter. And so you go, well, wait a minute, that means there's more than $40 billion in the first 6 months of fiscal 25, which means they're going to spend less than that in the next 6 months after growing 70 to 80% year over year for the last 6 quarters. So if you're any kind of chip company that sells into Microsoft or any of these other big hyperscalers, I think you're going to see a dramatic slowdown in revenues by the time you get to the middle of the year. And by the way, that's what you saw after all that investment during COVID. Because don't forget, Nvidia, which is the poster child for this trade, their revenues before COVID were negative year over year for about 3 quarters. And then COVID hit, and then the revenues surged to being up over 80% year over year by the beginning of 2021, because we're all locked up, right? We're all going online. Then once we all get unlocked, those revenues went from up over 80% year over year to down over 20% year over year. The stock got crushed, went down over 60% during that move from peak to trough. And then you got the AI trade, and you're back up to these levels. But I think you're going to see another slowdown after growing for 2 years over 100% year over year in revenues.
Dan, Nvidia is not in your top 5, but that doesn't mean you can't still make money with Nvidia. A lot of the guests that we've had on the show say that it is a must in your portfolio. We know that it's risen 800% over the last 2 years. There's still money to be had, right? Even if it's not going to be at the pace that we've been seeing in the last 2 years.
As I said, the last time you had to go through a digestion phase after COVID, Nvidia's stock went down over 60%, 60 from peak to trough. Right now, forecasts are for Nvidia's revenues to grow over 50% this year. I don't think it's going to be even close, because if you think about it this way, if your biggest customer is Microsoft, and it's growing, and it's going from growing their CapEx 70 to 80% to basically 0 in 6 months, you've got to think through that, because all of these big hyperscalers, they kind of move together to some degree. And so if Amazon and Google, et cetera, see Microsoft spending slowing down that much, and by the way, it's slowing down for a good reason, because you're spending all this money, but the question is, have you seen any return on that investment? So if you think about Microsoft in particular, especially given their relationship with OpenAI, when they reported the June quarter, they guided revenues below consensus for September, despite CapEx expectations going up. Then when they reported the September quarter, they guided revenues below expectations for December, despite CapEx expectations going up. So at a certain point, if you're not seeing the return, you're going to slow down that spending. And by the way, that goes for the other big guys as well, which is why I think you're going to see CapEx slow for the industry as a whole from growing 50 to 60% down into a 10 to 20% range. And I think Nvidia, I would be very careful on that stock this year. Now, it doesn't mean over the next, 3 years, 2 years, you can't see still growth. But I don't think anybody wants to go through a 60% loss like they saw after the COVID hangover. And you could see some very big downward revisions, especially when forecasts are for 50% growth for Nvidia's revenues in calendar 25. So that's why I think you have to be very careful of all of the AI-related stocks, because if Nvidia gets hit and there's an issue, everything's going to go down.
Dan Niles, we thank you so much for your assessment today. Founder, portfolio manager at Niles Investment Management. Thank you so much for joining us. Well, we take a closer look at the Israel-Hamas ceasefire deal after the break. Keep it here with us. This is Bloomberg.
After 8 months of nonstop negotiation, my administration, a ceasefire and a hostage deal has been reached by Israel and Hamas, the elements of which I laid out in great detail in May of this year. This plan was developed and negotiated by my team and will be largely implemented by the incoming administration.
U.S. President Joe Biden, during his farewell address, talking about the deal to bring a temporary hold to the war in the Gaza Strip. Let's get more details on the ceasefire deal with Horizon's Middle East and Africa anchor Jumana Basachi. Jumana, a truce that, a much anticipated one. Take us through the details.
Yeah, well, after many false starts, a deal has finally been agreed to, as we just heard from U.S. President Joe Biden there, alongside a press conference that Qatari Prime Minister gave yesterday, saying that the two sides, Israel and Hamas, have agreed to the contours of this ceasefire. Now, what we know about it is it in many ways resembles the original Biden proposal put forward in May of last year. It is multi-phase, composed of 3 phases, each one of 42 days each. The first phase is what is being dubbed the humanitarian phase, which will allow for the release of 33 Israeli hostages who have been held in captivity, some thought to be dead on return. But those will constitute mainly elderly, children, women, in exchange for some of the Palestinian prisoners sitting in Israeli jails. But alongside that, it will allow for the passageway of humanitarian aid assistance that is deeply needed. As we know, about 90% of the population in Gaza is at risk of extreme famine. And so the humanitarian needs are great and has been a big focus of the international community. The final element of phase 1 is that Israel has agreed to withdraw from the Strip to buffer zones along the border with Israel, with eventually the view that they're going to move on to phase 2, where discussions will take place about the release of the further hostages and a more permanent ceasefire. But the point here, Haslinda, is finally, it seems as though the two sides have agreed to this phased ceasefire. Whether or not it's going to lead to an eventual end of the conflict is a big question. But what we do know is that it does lead to the end of bloodshed.
We know that Netanyahu has come out to say that some details still need to be ironed out. Do we know what those details might be, and what are the implications of that?
From what we do know, Haslinda, phase 1 and the contours of phase 1, as I just outlined, have been broadly agreed to. What they do say is at no later than 16 days in the first phase, they have to start discussing what happens in phase 2, i.e. the release of the remaining hostages in exchange for remaining Palestinian prisoners, but then also what happens vis-a-vis this permanent ceasefire and whether Israel can accept the terms of a full withdrawal from the Gaza Strip. And if you remember, one of the war objectives that the Israeli Prime Minister had put out initially was he wanted to see the full demilitarization of Hamas. And Hamas still actually exists today. They still have somewhat of a governing authority within the Strip. And so that raises the question as to whether or not in Israel's eyes and the Prime Minister's eyes, whether this war objective has been achieved. And then second, who will be left to govern Gaza once these phases have been completed? And certainly the international community, the US, and even Arab states do not want to see Hamas have governance authority over Gaza. So these are some of the big questions and still sticking points that will have to be ironed out in the coming months.
Jumana, thank you so much for that. Horizon's Middle East and Africa anchor, Jumana Basechi there. Let's get more perspective on the Middle East with political analyst Julia Roknifard, who specializes in Iranian and Middle Eastern studies. Julia, good to have you with us. I'm just wondering how long you think this truce will stick. Will it stick long enough to get to the phases and discussions that need to be taken?
I think it remains to be seen within the first phase of realization of this truce. I think it's still very fragile and many people do not have high hopes about it. I didn't have high hopes about the possibility of a ceasefire earlier that we spoke about it here at Bloomberg. Neither do I now. We need to see what's going to happen, how the ceasefire is going to be realized within these coming 6 weeks, because we still observed that there is kind of under stress on the Palestinian side of the matter. President Biden did not really talk in his speech about the people that are supposed to be released on the Palestinian side. And also the amount of destruction that Gaza went through, there is, I think, only in the phase 3, some kind of effort is being considered for the reconstruction of Gaza, which is pretty much destroyed. So even if people are going to come back to their houses, they are not sure that they are still there. Most likely they are not. For these reasons, I don't think there is much to be said right now about how much it will hold. We'll see it after the phase 1.
But realistically, 6 weeks are not long enough. I mean, we're talking about 6 weeks to talk about possibly ending the war permanently.
Permanent ending of the war is also a very big question. We know that President Trump has that ambition. The president-elect President Trump has that ambition to end the war. And for that reason, he sent beforehand his representative to Israel, Stephen Witkoff, who apparently told to Netanyahu and his government that we need this deal right now, despite the objections on the part of the right-wing coalition partners of Benjamin Netanyahu. And this is pretty much what we know now. It's going to be a kind of a gain for the president-elect once he is to step into the office, which is just a few days away. But I don't think we're talking here about any permanent ceasefire, although that's the declared goal, because too many unknown questions remain of how Gaza is going to be reconstructed, who is going, as your colleague just said, who is going to govern Gaza, when elections are to be held. I don't think in the current ceasefire deal in any of the phases we haven't mentioned. So I would be rather skeptical and even pessimistic about how permanent this might be unless we come to any sort of actually permanent solution, like a two-state solution, which is we're a far cry from it right now.
Speaking of President Biden, let's take a listen to what he had to say about that truce.
Thank you.
Folks, credit for this, Mr. President, you or Trump?
Is that a joke? Oh, thank you.
There you have it, President Biden denying that perhaps Trump had a role to play in this truce. What's your take on it? Who's responsible for the eventuality of the situation?
Yeah, it seems that both presidents, the sitting one and the president-elect, want to claim credit, and fairly so, because one wants to see it, President Biden wants to leave it as his legacy, and as a legacy that cannot be undone by Donald Trump. But then Donald Trump also claims credit, including, as I mentioned before, by the virtue of his representative visiting Israel. I think it's kind of all the parties that contributed into this ceasefire agreement, both on the side of the United States, both the position of Benjamin Netanyahu within the political setting of Israel, because the pressure has been getting stronger on his government to release the hostages in the first turn. That's why people were demanding for the ceasefire deal now, so that other issues could be dealt with later. We also had participants of Qatar, who is very much interested in the deal because it wants to play a role of this middle power or small power diplomacy, one, and also be on the good books with the upcoming government of President Trump. So I think it's been a merger of different factors that came together so the deal could come true. However, again, I'm pretty much skeptical about how they declared political gains, this credit that whoever is going to attribute it to themselves, how it's going to turn into a permanent ceasefire, which is we are very far from it right now.
The thing is, Julia, the deal is no different from the deal that's been discussed for months now. I'm just wondering why now? Why the deal now? Perhaps Netanyahu doesn't think that Trump is the kind of ally that he once thought.
Oh, I think in Israel, it's pretty much the opposite. The Netanyahu government rejoiced with Trump coming to power because Trump used to be very lenient, very friendly, even overly friendly towards Israel. So in Israel, there is no problem with the Trump government, and this is why he sent his representative to talk to Benjamin Netanyahu and demand on the rights of the elder, of the senior partner, to demand the ceasefire deal right now. So I guess.
You talked about the uncertainty of the truce, also the uncertainty whether or not we can prevent this war from continuing. What would you like to see? What could be the right steps taken by both sides?
I'm afraid there needs to be a substantial change within how we see the situation in Gaza in particular and Palestine in general. That there have been some shifts in the public perception of the matter, and the demands in all parts of the world that we've seen that people demanded for the ceasefire deal and for this alleged genocide to stop in Gaza. We will need also, and that's something that's I noticed that is pretty much absent from the deal, the containment, the deterrence of further Israeli policies towards Gaza and towards Palestine. How this deterrence is going to be provided. Yes, there are guarantors to this deal, like Egypt or Qatar or the United States. But what are the mechanisms which they are going to use in order to deter Israel from going to Gaza again, from starting a military operation in Gaza again and just wiping it out pretty much of the whole Gaza Strip? We haven't seen it. We need this settled. And I'm afraid until there is more public, there is more demand at the political stage, it's not going to materialize, and we're going to see the repetition of what we already seen, many rounds of it, which the last one started on October last year.
Julia, thank you so much for your time today. Political analyst Julia Roknifard. Now, coming up on Insight, Microsoft's Vasu Jakkal on cybersecurity in the era of AI. He will be joining us for an exclusive discussion. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. As you count down to the second Trump administration, the new administration is ramping up the rhetoric on China of a growing list of security concerns, including a recent spate of cyber attacks linked to China. Here's what Marco Rubio, Trump's nominee for Secretary of State, told senators at his confirmation hearing.
We welcome the Chinese Communist Party into the global order, and they took advantage of all of its benefits. And they ignored all of its obligations and responsibilities. Instead, they have repressed and lied and cheated and hacked and stolen their way into global superpower status, and they have done so at our expense and at the expense of the people of their own country.
Let's dig deeper into those concerns and bring in our next guest. Vasu Jakkal is Microsoft's Corporate Vice President for Security, joining us from Hong Kong. Vasu, good to have you with us. We talk about those security concerns, and we saw that attack on telcos by Chinese hackers. I'm just wondering, when it comes to those attacks from Salt Typhoon, how are you assessing the impact? I suppose, what's been the impact from those attacks?
Yeah, first of all, Haslinda, it's great to be here with you. Thank you so much for the opportunity. You know, to look at the situation of cybersecurity, I would love for us to just step back, because in this era of AI, which is super exciting for us, we're seeing 95% of organizations embrace AI, use it for innovation and creativity and productivity. We also continue to see a really complicated threat landscape. You know, from the front lines of security, Microsoft has been tracking the exponential rise of cyber attacks. We're seeing, just 2 years back, we were seeing 579 password attacks per second, and we're seeing 7,000 password attacks per second. In addition to nation-state, ransomware has really grown as a gig economy. We're tracking that closely, and we've seen a 275% increase in human-operated ransomware. And we continue to invest to understand the motivations, the why, the what, the how behind all the threat actors. And Microsoft is tracking 1,500 unique threat actors across the world right now. So it is a complicated threat landscape. We continue to monitor, we continue to partner across the industry and across the public sector on making sure that we understand this asymmetry, and we are using technology like AI with our security co-pilot to change this landscape and to tilt the balance in favor of defenders.
That's all well and good, but some reports are suggesting that the attacks by Salt Typhoon, the Chinese hackers, actually used the same techniques as when British Telecom was attacked some 40 years ago. I'm just wondering what's been learned, and why are we still going through this if we're investing a lot of money and paying a lot of attention on cyber attacks?
Well, the attackers use novel techniques. They are evolving as technology evolves. And we have published some extensive threat intelligence on Salt Typhoon and other actors with respect to what we have seen. As new research comes into being, we'll do that. But I do believe there is motivation in terms of financial crime for these actors, as we have seen. And so as long as technology innovates, these actors are going to use that for their own benefit.
And of course, for the U.S., it wants to invest in protecting its companies. It wants to invest in protecting the country. Let's take a listen to what Jake Sullivan had to say.
We're going to have to continue to deter China from doing that because we have seen them setting up or positioning to be able to do that in the future. And it's something the new team will have to continue to work on deterring.
Vasu, to what extent is Microsoft working with the U.S. government to prevent such attacks happening again?
Yeah, Microsoft, we believe that security is a team sport. We believe that we need to work closely with the public sector and the private sector on making sure that we are always at the forefront of security. In just 2 years back, in November 2023, we launched our Secure Future initiative. And just last year, we doubled down on it. And as our CEO, Satya Nadella, says, security must come above all else, especially in this AI transformation. We have worked with the US government on making sure that architectures like Zero Trust, which start with identity and verifying explicitly, are mainstream. And we will continue to work with all the public sectors, the US government, going forward on ensuring that we have the right cybersecurity practices, including skilling, including driving awareness, and of course, using technology and cybersecurity solutions to help defenders get an edge.
How does that security landscape look like post-Salt Typhoon? How should it look like?
Well, I think that going back to, if you just look comprehensively at what's happening at security, security attacks can come from anywhere. And every single organization today is vulnerable, no matter who you are, no matter where you are, how big you are, how small you are, whether you're public sector or the private sector. And so I think as we look at security and we look at how the attackers approach security, they think in something called graphs, Haslinda, where they might use a phishing email to get initial compromise, or a website, install malware, and then move laterally to escalate privileges. So as we look at this landscape, one of the most important things for us to do is look at security end to end. First and foremost, we need to track all we can. And this is where the signal intelligence that Microsoft has continues to be very important. Every single day, we track 78 trillion signals, threat signals, which help us really understand what is happening. We use these threat signals then to integrate those into our technology solutions to not just detect and respond, but really prevent attacks from happening. And one of the things that I'm really excited about, in addition to using AI for security and using Copilot to just make it faster, is things like exposure management, where now organizations can use tools to see all the potential ways that attackers and attacks are happening and prevent those. So the threat landscape continues to be complex. It's also not helpful that we have a global talent shortage in security. There's 4.6 million jobs that are unfulfilled today, 2.6 million in Asia. And if we don't train our security defenders, if we don't reduce the barriers to entry, then we're going to continue to have this asymmetry. So I do think going forward, we will continue to see an escalated threat landscape, a complicated threat landscape. And we as defenders and organizations, including Microsoft, need to do all we can to bring these things together, to use technology, to use AI. And then lastly, we need to work with the ecosystem. We are big believers in a platform approach. We work with many, many vendors. We have 15,000 partners, and we need to continue to do that.
Where are the biggest vulnerabilities for companies and for governments?
Yeah, it's not any one thing. If we continue to see identity as a battleground for security, we are seeing 7,000 password attacks per second. In Asia, based on the analysis and reports that we have seen, we continue to see phishing as a big vector. And then we will see threat actors use every tool at their disposal, including Gen AI, to get more productive, to get more efficient. So unfortunately, in security, there are many ways that attackers can get in, and we need to make sure that we stay ahead of that and we protect comprehensively.
As you talked about the complexity of technology and how AI increasingly is being used for cyber attacks, I'm just wondering whether you're seeing enough talent out there to actually help fight cyber crimes?
That's a great question. I wish we had more talent, and I invite everyone to be a defender. We are seeing a big gap in the security talent. Security is hard. You add the pressures of fragmented tool systems and these teams which are already having a hard time distilling between noise and threat signals, and it makes life challenging for them. We need to make sure that we are training our people. We need to make sure also that security is not only a security team's responsibility, but the entire organization's responsibility. And this is one of the reasons, Haslinda, where at Microsoft, we think of security as a cultural transformation, not just a technology transformation. This is why we made security a core priority for every single employee, and we are skilling them. In our Secure Future initiative, we have the equivalent of 34,000 of employees who are working on security, and we are hoping that we'll use this to drive best practices in industry and to invite others to join us in this movement.
And boosting cybersecurity requires a lot of funding. In your conversations with companies and governments, are they committed to spending on that?
I believe so. We see that cybersecurity continues to be a top priority for CIOs. Of course, it is the biggest priority for CISOs, a big priority for CEOs. Microsoft is also investing in R&D. A few years back, we shared that we are investing $20 billion in R&D for security. That's $4 billion a year. And we will continue to make sure that we prioritize and invest in this. And the Secure Future initiative is another example where we are really doubling down. And we see the same across the ecosystem. We see across our customers and our partners. I'm here in Hong Kong for our AI tour, and all the conversations that I'm having up with our customers right now just gives me a lot of hope because they are investing, they are prioritizing security.
Vasu, thank you so much for your time today. Vasu Jakkal, Corporate Vice President, Security at Microsoft. 11:54, it has been trading for almost 10 minutes now. Let's do a check on how those companies due out with earnings are doing right now. Reliance Industries currently in positive territory, up 0.2%. Infosys also higher, along with Axis Bank. Of course, we're looking at earnings to judge if those accelerated valuations can be justified. Now, before we go, here's a look at Insight for tomorrow. Boston Consulting Group's Neeraj Agarwal will be joining us to discuss the most pressing risks for businesses this year and his expectations for the World Economic Forum in Davos. Plus, we speak exclusively with the Philippine Energy Secretary about the country's power deals, as well as planned shift to renewables. That is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.